Hello and welcome to Wisdom Bites. Hope you're well. Thank you once again for joining us. Very much appreciated. And in today's program, the main theme of the video is going to be on a Bitcoin repeating chart, which says that there is a massive move coming on the way and why you shouldn't miss it. So we're going to focus mostly on this particular chart and see exactly which direction it wants to go. And as per usual, we'll have a look at the overall picture of what's happening with Bitcoin and the wider markets and what's in the news, as well as analyzing the 60-day cycle for the short and the medium term. So if that sounds interesting, you know what to do. Get yourself a cup of tea, sit yourself down, eyes on the screen, and let's get cracking. But before I begin, the usual polite reminder, please remember everything in my videos is just for educational purposes, so please always do your wider research before you make any investment decisions or any swing trade decisions. So what is this Bitcoin repeating chart, which shows that there is a massive move on the way? I want to take you to the weekly time frame here, and I'm going to take you from the bottom of the bull market. This is where we started off, at the end of that bear market here at the end of 2022. And this particular pattern seems to be repeating all the way up here to the current price action that we've got around about the 100,000. And one of the members inquired about how you get the bear market signs here. If you go into the settings, these are the inputs that I've got on my settings. So in my inputs, I've got the RSI length at 10, and the usual standard setting is 14. So I've changed that to 10, and the style is this here. And you see that the bear market and the bull market signals, so I've got the regular bullish signals in green, which is this one here, and the regular bearish signals in orange. One of the reasons why, if you've been watching my channel, you'll know that here at Wisdom Bites, we got in at the 17,000 and the 15,000. And that was with the Bitcoin miners, not with Bitcoin. And one of the indicators that we used at the time was the RSI signals, where we saw a lower low on the price, but a higher low on the RSI, which gave us this signal here, the bullish signal. And you find this time and time again, that whenever you get a bullish or bearish divergence, there's a very high likelihood that the price action is going to actually follow through. So the pattern I want to show you is this particular pattern. If we take it from the bottom of the bull market, which was here on the RSI, and you see that we made a move all the way above the 70 line here, the blue line, which took us to this price action. And that usually tells us that we're going to have some sort of a consolidation or a pullback, which is exactly what we had down here. And then what we normally get is a second rally where the price action goes above the previous high to make a higher high here. But if you see the RSI, that's giving you a very strong signal that if it's not going to make a new higher high, then that is a divergence, and that the price action after that is going to be more consolidation or pullback. So that was the first time we got this bearish divergence here. So the next time we had a run up, which was from this point, we went above the 70 here. So this is where we got to the 70 first time, and that was at this point. Then we dropped back below the 70, and that was this consolidation. And what happened after that is that once we broke up above that, we got another higher high, a very steep higher high on the price action. But if you look at the RSI, we actually made a divergence, although there isn't a signal for divergence because it's about the same. But divergences don't always have to be a lower high here. If there is a flat lining on the RSI and a steep rise in the higher high here with the price, that is still a divergence, or that's how I read it anyway. So that was another signal that we're going to get a pullback over here. And once again we got another rise at this point, which created another new higher high here, whereas this time there was a proper divergence making a lower high on the RSI. So here you had two bearish divergences. And as we know, that divergence here was the long 8-month consolidation that we had, which ground everybody down. But what we've had since then is that we've gone back above the 70 one more time here, which took us to the 108,000. And once again, we're having another consolidation pattern, which is down here. And as you can see quite clearly, we've broken back below the 70, and each time we've had these consolidations, we've come back and made these bearish divergences here. So you can see quite clearly where we are now, that there is a very high probability that we're going to move up here, make a new higher high, whereas on the RSI, we're probably more than likely, with a high probability, going to make another bearish divergence, which will allow us to go up here, wherever that's going to be, and we can do a measure to see where the next targets are, and that will be our next consolidation pattern forming up here. And when we have a look at the 60-day cycle, it seems to fit in with what's happening on the RSI here, on the next leg up. And so this is the massive move that we're going to get in the coming weeks. So before I get a comment within about 20 minutes of doing this video that this video hasn't aged well, this move is not after 20 minutes or 1 hour or even 1 day or even 1 week. We're talking about in the coming few weeks. So what are the targets that we can look forward to when we get this big move to the upside? If we use the Fibonacci retracement level from the previous high of 69,000 down to the 15,400 at the end of the bear market, you can see that our target previously of 104,000, this is exactly where the price had actually come back up to. The highest being 109,000, but it came up to the 1.272. So what we now have are two further targets, the 1.414, which is at the 128,000. So this move should come up at least to the 128, call it 130,000. And if it doesn't respect that level, it'll go to the next level, which is the 61.8 at 175,000. So these are our next two targets, according to the charts and the Fibonacci retracement, which has been very accurate so far here. So this is the next move. Now, the question is, when will this come? And as I showed you on the weekly chart, these are going to be playing out over the coming weeks, not in the coming hours or days, but we will do a short-term analysis to show exactly where the price is heading in the coming days as well, by looking at the 60-day cycle. And if we have a look at one of our Bexit indicators, which is the pi cycle, that's the green line, which is the 111 simple moving average, against the red line, which is the 350 simple moving average, we can see that the price is just coming back and finding support on the green line. But the most important thing to remember here, and we need to keep on monitoring this and keeping an eye on this, because what we're really expecting for the end of the bull market is for this green line, as per the historical context of all the peaks in the past, this green line has crossed the red line. Even though those crosses have become less pronounced, we know at least that this green line will come very close to the red line, even if it doesn't cross it. And at the moment, the main thing to remember is that this green line, the trajectory of which is very much to the upside. So you know exactly where this is heading. And obviously the 350 simple moving average, which is a slower moving average, but with a much less gradient. So somewhere along the line it's going to cross or come very close. And that'll mark the end of the current bull market, if the historical perspective is to play out. And we have no reason not to expect that. So that's where we're at in terms of the medium-term picture. In the coming weeks, we're waiting for a move back up here on the RSI to create a bearish divergence. But for this move to come up here, the price has to break out from the 109,000. And the pi cycle, as you can see quite clearly, the gap between the green line and the red line is still quite pronounced. So we know that there is still quite a lot of room for this bull market to go. Possibly 6 months, possibly 12 months, anytime in between. And if we move on to what's driving the markets in terms of the news, people are blaming the current consolidation for Bitcoin on the introduction of a lot of the tariffs from the new administration in the USA. So whatever is driving it, but certainly it's out there. And this time there's an added 25% tariff being put on steel and aluminium. And if we have a look at the liquidation heat map, which gives us a very good accurate picture of the stop losses which may get triggered in the short term. So in the coming days, if you're looking for a short-term picture, this has proved very accurate. And the most pronounced level at the moment on the lower side is 96,000 here. But as you can see, there are less pronounced areas, such as this here at 94,700. So I would keep an eye on this 94.7, although we've already been to 94,700 just recently over here. And this occurred over the weekend, but quite easily we could come and double bottom on there, or even go slightly lower when we look at the 60-day cycle. But on the upper side, what we've got is about 98,100. So it's quite conceivable for the current price to go all the way up to the 98,000 to take the stops off the leverages at that price. And if we have a look at the Bitcoin ETF overview and look at the asset inflows and outflows, there is a changing picture emerging, because what we see now over the last 7 days, we can see quite clearly there is more green than there has been for the last few weeks. So as we come out of the current consolidation, we can see that the ETFs seem to be behaving in a way that we're going to be going more to the upside rather than to the downside. And we're getting some very healthy inflows of 3,000, 5,000, etc. And the outflows are not very high. So overall, an emerging bullish picture with the Bitcoin ETFs. And if we move on to the US dollar, we mentioned last week that there was a bearish divergence on the weekly time frame where the value of the dollar had gone up significantly, and this was giving us a signal that we're going to be coming back down. Obviously, we've gone to retest the upper levels here and left a longer wick at the top here, so there seems to be with a high probability that we're going to be coming back down over the coming months, which would allow the wider markets to push higher. And the daily time frame seems to be confirming that particular trajectory when we see this gravestone doji candle right at the top of this trend that we've got. So it was a big run up to the level of 109, and we just seem to be getting a counter trend rally here before the move back to the downside. And if we move on to gold and look at the monthly time frame, so the longer term picture looks incredibly bullish here, where we're making another solid green candle for February, having broken out with this Marubozu candle in January. So the monthly picture looks very good. The RSI seems to be moving up, and this may have a few more months to go. It could be 5 months, it could be 6 months. But on the shorter term time frame, so what we've got is a very strong move up here, and we've had quite a few where the momentum has come to a halt along the way, and it seems to be ignoring some of those bearish signs here. And of course it can carry on going up, and we got one more shooting star candle which would have given us the impression that this is going to come back down. Just like over here, this was ignored. So when we have an emerging picture which is very bullish, sometimes some of these high probability plays of shooting stars and outside bar candles and gravestone doji candles, which are signals that the momentum has come to an end, they can be ignored when there is so much bullishness and buying power in the market. So this is what it's doing at the moment, but sooner or later we are going to get some sort of a consolidation and some sort of a pullback to take the heat out of this big move that we've had so far over the last few weeks. And if we move on to the SPX and look at the SPX through the eyes of the 60-day cycle, we can move the end of the cycle here. So we're now in a new cycle for the SPX, and we've had a nice move up here and coming back to retest old resistance from previously. So the SPX has a clear run to go into the mid-cycle at much higher levels than the previous one here. So I would expect this to now break up above the 6,100 before we have the mid-cycle decline, possibly back to this level here, 6,100. And then we go again in the second half of the cycle. So this looks very bullish, and with the dollar looking seemingly to be coming down, it gives a lot of room for maneuver for the SPX as well as the other wider markets. And looking at the 60-day cycle, there seems to be a lot of indecision candles marked up in the last few days. So what we've got so far is that from the beginning of the last cycle here, on day 56 of the previous cycle, we're currently on day 42 today, Monday the 10th of February. And so far, after the inauguration, this orange line here on the 20th of January, what we were expecting was a run up into the inauguration, which we actually got, and then we've had a mid-cycle decline, which has had two legs. So this would have been your normal bottom here, but we've had a second leg down as part of the mid-cycle decline. And the question is, where does it go from here? Our end of the cycle will be around about the end of February. That'll be the 60 days. Obviously, we have room to maneuver on either side of that line. So we could come to an end of the cycle within 10 or 15 days of that line. So we're coming into range of coming to the end of the cycle. And the main thing to consider here is that there are two ranges we need to look at, and that is this 96,000 line. If we can get into the end of the cycle at this range, i.e. above the 96,000 line, then we set ourselves up to come into the 60-day decline, and then it gives us a very nice room to maneuver to get up and make that massive move into the midpoint of the next cycle, which would be at the end of March. So this is how I'm seeing it. As long as we stay above the 96 to 100 range here, then that will give us a good probability of a move to break above the 109,000 here. But should we consolidate in this range at the bottom, then that's going to take a lot more energy and power to get above that. So we could easily, if we did actually consolidate at the lower range of that 92 to 96, we could spend another cycle here But as we saw with the RSI, that increases the probability that we're more than likely going to be in the upper range rather than the lower range. So let's see how that plays out. And always remember, this is a game of probabilities. There's no guarantees or certainties here. If anybody's looking for guarantees and certainties, you're really in the wrong domain, and you're probably going to get punished by the markets if you're looking for certainties to play out. So this is how I'm seeing the medium-term picture. As we saw with the RSI, if you look down here, the stochastic RSI seems to be gearing up for a move to the upside here. And we're also seeing some hidden bullish divergence where the price action has made a higher low and we've got a flatlining RSI here. So the signals are that we should start making our move. And if we examine this price action a bit more closely, we'll get a very good view of what may happen in the coming days on a short-term picture. Before I look at the daily time frame for the coming days, I want to bring your attention to the weekly time frame candle that just closed last night. And just like that long-legged candle that we got on the daily time frame, here we've now got a similar long-legged candle on the weekly time frame. So if we put a ray at the top of that, which is at 102,500, and a ray at the bottom of that wick, which is at 91,200, we've got a new range for the price to move in. And if we have a look at the volume on this particular candle, we can see quite clearly it is one of the lowest volumes. So this candle, the long-legged candle, won't be as powerful as the long-legged candle that we got on the daily time frame, which had a very high volume. So we always need to consider that. So while this particular candle is going to give us the top and the bottom ranges of where the price action is going to be in the coming next few weeks, it's not really strong enough to be able to stop a move to the upside or even a move to the downside. And obviously we're expecting a move to the upside. So considering what's happening on the weekly time frame with this particular candle, which just closed last night, and the main thing to consider here is that what we had was a downturn down to this candle here, this hammer candle. And with the long wick at the bottom, this established the bottom for the midpoint of the cycle. And since then, what we've had is this inside bar candle telling us that there is a loss of momentum to the downside. And then that was followed by a gravestone doji candle here, which was giving us more of a pressure to the downside. And that was followed by a second gravestone doji candle. And whenever you see two gravestone doji candles, especially at the top of a trend, if ever you get these two candles like this at the top of a trend, you really have probably one of the highest probability trades that you can take, because those two types of candles here would give you a 90% probability that it's going to play to the downside. So this is where you would take a short. However, these occurred at the bottom of a trend. So while they're still powerful, and they would take the price to lower than this level here, which is exactly what it did here yesterday. The lowest came down to was 94,700. And what we got here was a dragonfly doji candle, which is a bullish candle now to play to the upside. So the momentum has now shifted back to the upside, having had the short-term price action play out because of these two gravestone doji candles. It doesn't mean it can't come back down again, but as we know, this is a game of probabilities. The probability has shifted now back after yesterday's close here, back to the upside. And the thing to consider is that this hammer candle hasn't actually played out yet. What we've got is that the subsequent candles here are actually running down the wick of that hammer candle here. So often what you get, so we've seen this play time and time again. If you look back here, we had this hammer candle, and this next candle ran down to around about halfway of this hammer candle. But eventually, this is what happened. On this one here, we had no rundown on this wick because the momentum was too strong and it went straight to the upside. But on this one here, we got another rundown on the wick of this, but eventually we went and broke above it. So this is what I would expect. Now, having run down on the wick around about the halfway point one more time, the next move should be to above this level. And we want to really get to the high point at the end of the cycle, which is at the end of February. So my expectation now is that going into the end of February, that we should be more at the higher range. If we go back to the 60-day cycle, so this is what I'm expecting because of this particular candle and the effect it's having here. We should be more going into this range to break above this level, which was set up nicely going into the end of the 60-day decline and then having the chance to break up. And then the divergence on the RSI would be able to play out to the upside. Okay, so I'm going to leave it there. I hope you found value in the video. If you did, then please do remember to like and to subscribe if you haven't already done so. And if you've got any comments, leave them in the comments below. Until the next time, take care, stay safe, and I'll see you in the next video. Bye for now.